Making this video on trading. I have been a trader for the past 5 years, and I have seen that majority of the retail investors actually lose money, and there's only a fraction of investors that actually make money in the long run. So the key is to be profitable on a consistent basis. So we will be looking at some basics as well, and then we will be looking at the advanced strategies and techniques that needs to be employed and what you can do to be profitable on a consistent basis. So if we look at the whiteboard here, we know that market operates in cycles. So if it's, let's say, it's going up, then it cannot keep on going up forever. It has to come down, and that's a sell off, and then maybe it accumulates and then goes up again, right? So we and then once it goes up, then it has to come down eventually, right? And that's how markets work. So either they go into the impulsive wave. So let's remove this. So, so the markets can either have an impulsive wave, or they could have a ranging environment, which is basically, this ranging environment could be, you could say, a distribution at the top or an accumulation at the bottom, right? Now, what happens is that we tend to use a lot of different kind of indicators. That's the problem of retail investors, right? Because there are so many strategies that you can look at, and that's available on the market, and what works for one may not work for the other, right? But those are the retail strategies that you have been taught, and that it's follow the herd strategy, right? So if, let's say, I tell you that if I turn on the moving average indicator, and then if someone tells you that the moving average, if, let's say, the EMA 7 is crossing EMA 21, then that's a bull cross or a bearish cross. That's not how it works, right? So because if you're waiting for the crossovers, those are like retail strategies. If you're following the retail strategy, and trust you me, I have been in this industry long enough to know these things. I have made those mistakes myself. I have lost a lot of money, and then I made a lot of money. But then, as we say that in trading, first you lose money, then you learn not to lose money, and then you start earning, right? So that's what we need to do. So in trading, there are a lot of different strategies that one could employ, but you need to see what really works best for you. So that's what trading is all about. So if you know that what you're working on, and if you know that what you're working on really works for you, then just stick to it. I was so If, let's say, you have been trading, and no one told you about how the institutions work, how the big players work, and how the smart money works, then you're completely screwed. Because when we talk about how the institutions work, how the big players work, they don't want you to make money. They want you to lose money. They want you to be used as a liquidity grab, right? So if let's say you are a big player and I am a retail investor, then you want that I at the end of the day I end up losing, right? So there would be moments when you make money, and there would be moments when you don't make money, and at the end of the day, when you look at the net position, you would be losing the money. So that's what it is. So if you know what you're doing, so we have a trading pair of Just Me USDT, right? And in this series of videos, what I'm gonna tell you, you could apply that to forex, you could apply that to crypto, and you could apply that to stocks as well, because I'm gonna teach you about price action. I'm gonna teach you about how the markets work. Okay, so this is an example of Jasmy USDT. So we took two trades for Jasmy. Okay, so one trade was a long, which basically we had a very decent rounding bottom here, as you can see. We had a perfect rounding bottom from here, and then we took the trade from 0.3760 right up to the top and made about 10% gain. And if you're using leverage 2x 3x whatever it is, you could make 20 to 30% straight within a day, right? So that's what it is. And once it reaches the top, now you're not supposed to stay in the trade. The key is that keep taking profits. So let's say if you entered here, and if you entered somewhere here, and if let's say that your profit, if the price has moved, and your let's say that this is the trade that we had taken. Our stop loss was here, and this is what we had. Okay, so if let's say the price came here, so you're almost 3.55% up. So on a 2x, it's almost 7%. You could take 25% profit and move your stop loss, right? Once the price comes up, even here, so you're up 6%. So on a 3x, it's 18%. On a 2x, it's 13, almost 12.5%, right? So as long as you are taking the profits on the way, that is, whenever you are profitable, you don't have to give money back to the market, because that's the key. You don't have to be greedy all the time. It's good to ride the whole wave, but you cannot catch every single move in the market. As long as you're profitable, if let's say you make 30% and the whole wave was for 40 or 50%, so that's perfectly fine. The end result is you have to come out of the market in a green position, right? So as long as you do that, you will be profitable on a consistent basis. Now, once we have looked at this, that there was this rounding bottom here, we had taken a long on the Jasmy position. So right when it hit the targets, there's another concept which is called, let me remove this first. So there is another concept which is how the institutions work. So if I go on the higher time frame, which is 4 hours time frame, and we see the bigger picture here. So once once the market breaks a structure, so let's say that the market was trending down. Okay, so this is a market which is trending down. So once the market creates a new high, so which is, let's say the market created a new high here. So that's a break of structure, right? So there are two kinds of breaks of structure. So one is when the market makes a higher when the market makes a new high, which is in this case, the market made a new high, so that's a break of structure. And or a market makes a new low, so that's a break of structure as well. So there is a break of structure. There is a break of structure here as well, because the market has made a new low. So that is called a break of structure. Now, when the market is trending in a direction, so let me open this indicator, which is called the market structure break. So when when the market is trending either upwards or downwards, that is in one direction, and if let's say over here it's going downwards, then as the market keeps on making newer lows, that is lower lows. So we say that there is a break of structure, right? So because it's creating a lower low, so it created a lower low here, then it created a lower low. Another lower low was created here as well. So that's a break of structure. Now, once the break of structure happens in the opposite direction, but that is here. Once the break of structure happens in the opposite direction, that is basically called as a market structure break or a change of character. So which basically means that we know that the previous high has been taken out and the market is now reversing, right? At least in the short term. Okay, like this reversal doesn't mean that if let's say Bitcoin is sitting at $14,000 and the market is reversing and the Bitcoin is now headed towards $40,000, right? That's not how it works. It just basically means that at least in the short term, the market is reversing. Okay. So because we are using the 4 hours time frame for this particular example, okay? So now you can see that I gave you an example of a market structure break, which technically is a break of structure, but when the market is trending and the structure breaks in the opposite direction, that's a market structure break, okay? So if we look here, we know. If we look here, so we can say that the market went here and then it broke the structure, which was a market structure break. Now, whenever the market structure breaks, right, there's a concept called as order blocks, which is where the smart money concept comes into play. Okay, so this is your order block. Okay. Sorry. So this is your order block. So when the market structure breaks downwards, this is the last bullish candle that led to the break of the structure is where the order block forms. Okay. So an example of an order block is, let's say you are the institutional player or the big player or the whale, however you want to put it, and I am the retail investor. So so you have $100 million worth of Ethereum that you want to sell off, and we being the buyers in the market, we being the retail investors, the smaller players, we only have the capacity to, let's say, buy a total of $15 million worth of Ethereum. So what's going to happen is that if you being the big player, you float $100 million worth of Ethereum into the market will fall, the market will crash, and you will not be able to get the price that you want for your $100 million worth of Ethereum. And so you don't want to do that. So the concept of order blocks comes into play, which means that you put those $100 million worth of Ethereum sell orders into chunks of order blocks. So let's say if you have a buyer of $15 million, you sell off a $5 million worth of Ethereum, and then you wait for the price to come back to the order block and then execute another $10 million worth of your sell orders. So that's where the institutional players get the price that they want for their particular coin, right? So what happens is the strategy that I firmly believe in, and this is after a lot of hard work that I came across this, and this has been working so perfectly fine. Like, this is not 100% strategy. I would say that we have losses. Every trader on this earth has losses, right? You cannot get 100% win rate, but the trick is to contain your losses and maximize your profits. At the end of the day, you will be profitable consistently. That is, as long as your risk management is perfect, and we will talk about risk management in other videos later on as well. So that's the key. Now, in my earlier example, when I was telling you that we had done a long for Jasmine, so I knew that there is an order block right here. So we sold off just me long somewhere here, and once that trade was executed, about 30-40% we had made on the long. So we straight away went ahead, and I knew that there is an order block over here on 4 hour time frame, and the price will touch here and then come back down. We placed a sell order straight away, and the price went right from here. The stop loss was right above the order block. The price went straight down, and you can see that you would have made approximately on 2x or 3x about 16 to 24% in just a few hours. So that is the beauty of order blocks. The moment the price hits a bearish order block, there are sell orders sitting here, which a lot of retail investors, or I should use the word majority of the retail investors, don't know about it. The price would come back down, and that's your straight profit. You've made the trade. You lock in your profits, 25%, 25% profits on $10,000. It's about $2,500. You make $2,500. You go home. That's it. And that's all for today. Thank you.